Hello and welcome once again to Policy Bazaar. I'm Arjun Bhagat. During the autumn of 2009, I was trying to make sense of my tax liability for the financial year and also planning for investments which would have helped me save maximum tax. But what scared me was the prevalent market scenarios. Every major mutual fund or ULIP with equity component was in the negative zone. I as an investor was simply scared. Now most of us have fallen prey to ULIPs which were not suited for us. At first, they were aggressively sold because of high commissions and then by packaging along with the word guarantee. This word made us believe that the product will protect us in the downtime and still give us the upside of good returns. Next day in office, I heard a colleague talking prudently about his purchase of NAV guarantee, ULIP. Now, this made me think of two things. How come I did not know about them, and are they actually that good? To know more about such products, we have Yashish Dahiya with us, co-founder and CEO of PolicyBazaar. Welcome to the show, Yashish. Now tell me, what are ULIP guarantees and what does it really mean, and how does investor benefit?
Sure. So in about 2008, when the market crashed, all people who had invested in ULIPs lost out. Prior to that, the market was going up very rapidly. So even with charges, people were able to make a little bit of money, 4–5%. However, when the crash happened, people lost a lot of money. And about 80% of what the private insurance companies sold were ULIPs. These products were loaded with very high front-end charges. But the market dropping exposed not just the charges, but also the volatility inherent in those products. Very soon after, companies started providing products or offering products which had some form of guarantee to the consumer. Now these guarantees come in two formats. One is known as capital guarantee. So in the capital guarantee, it basically means whatever capital you invest is going to be guaranteed. So if you invest 1 lakh rupees a year for the next 10 years, the minimum you would get back is 10 lakh rupees. Now that's a terrible return because you might as well keep the money in your bank, but that's still guaranteed. Right? It could have gone down in a imaginative scenario. The second thing that came on were products which gave you a highest NAV guarantee. Typically how these products work is from the day you invest, there is a particular day of the month on which they track against their price. So suppose you invested at 10 rupees and it goes up to 11 rupees in year 3, then it gets locked out at 11 rupees. So it is tracked for the first 100 months or for the first 7 years on a monthly basis. And whatever is the highest amount that this particular investment of yours reaches in that period gets guaranteed. Now what this saves you is from the vagaries of the market in the last 3 years. Most of these products are 10-year products. So in the first 7 years, you stay volatile. However, wherever you hit highest in the first 7 years is guaranteed by the end of the 10th year. So the last 3 years you do not face volatility, and from that sense they do tend to be good products. Now of course the market uses various techniques to achieve these, etc. One of the you will not get the same return as you would in a pure equity, but you do get the guarantee that wherever you reach at the highest point, that gets locked in effectively. There is a negative of these products. These products are very good if you have a zero volatility market. So as long as your investment keeps going up, that's fine. Now,
well, that doesn't really happen, does it?
That doesn't really happen. In the real world, the markets move kind of, obviously they oscillate. And the way this product works is the moment the market goes up and it starts to come down, very quickly funds are moved from equities into debt to protect your position. Now, what does happen is, in case the market comes back up, you were in the debt. And hence, you would not achieve actually the highest point. So let me take a very simple example. Suppose you invested in a stock and assume somebody wanted to highest NAV guarantee that particular stock. You will not get the highest return that stock was able to give in the 7 years. You will get something less because the moment the stock drops, you would have to move into debt. And what that implies is when the stock does rise back, you would still be in the debt and you'd miss out on that growth.
Okay, so they don't really switch back again.
Not very quickly. Not very quickly. It would only
because
switch
they follow
back.
a certain cycle. So then that's something that investors need to be really aware of.
Absolutely. So it'll take you a longer time, a longer gestation period to, or not the same return. You won't get the same return as you would in a pure stock investment. And that's very important to understand. Now, one more factor is, if you look at the market over a 10-year period, over a 7-year period, the market always gives you pretty good returns. So, according to me, if you look at it from a very pragmatic perspective, it wouldn't make sense. However, from a psychological perspective, these products do make sense because they give the customer some comfort. Now, in addition to the lock-in, there are certain guarantees provided by various products. So, some companies will say, if you invest 1 lakh rupees every month, the minimum we will guarantee you, or every year, the minimum we will guarantee you at the end of 10 years is 15 lakhs. So, they say, 15 rupees the minimum NAV we would guarantee to you. Some companies will say 10% more than the highest NAV. Some will say 5% more than the highest NAV. So, there are certain other guarantee benefits that do come along.
So now tell me, which investor is ideally suited for this, and who would you advise against getting into NAV guaranteed plans?
See, if you are young and you've got 20, 30 years plus before retirement, I think you should go for pure ULIPs or pure mutual funds with a term plan, either one of them, and they both have their benefits. I think if you had about 15 years, if you were about 15 years from retirement, so if you had crossed the 45-year age bracket or 40 plus, then it starts to make sense to think about highest NAV guarantee plans, because see, the market is strange. While it's never behaved this way in the past, this is pretty much the first time that we are below where the market was 5 years ago. So we are still below the 2008 point from a market perspective, and this is very, very rare, but this can happen. And you don't want,
and sometimes when you need the money,
that's the law is always kind of working against you. So I think you don't want that kind of a risk when you're very close to retirement. Now, so 40, 45 plus is the right age when you start looking at highest NAV guarantee products.
So you're not really advising against it, are you?
I'm not advising.
You don't seem that enthused about NAVs.
I'm not necessarily advising against them. I think the products have a certain advantage. If I wanted to de-risk my return but still get better than debt return over a 10-year period, I would go for highest NAV guarantee products. However, these products do tend to have higher costs also. So see, if a market, if a fund manager is putting your money into equities, he has less management to do. Whereas if he's putting it into highest NAV guarantee, he has more management to do. And essentially these products will have a few more percentage points of fund management charges. They will also have a few extra points. So about 0.5% is the extra fund management charge. Now you got to remember one very important thing. The fund management charge applies on your entire investment.
Yashish, can you tell us what fund management charges are and how does one understand them?
So I think one of the most important charges out there is the fund management charge, and thanks for asking that question. I just want to elaborate what 1% of a fund management charge means. So suppose you're in the 7th year of your policy, you've invested 1 lakh rupees every year, and your portfolio is built up to about 10 lakh rupees, right? Now, 1% fund management charge on the entire 10 lakh rupees is 10,000 rupees. This will be deducted before you see your NAV. So a fund management charge does start to become very significant as your fund starts to build up. And one has to watch out for this. A 0.5% difference in fund management charge over the lifetime of a policy can create an impact of almost 75,000 rupees over a 10-year period. And that starts to become significant.
All right, and there are concerns about mis-selling of NAV guarantee products. I mean, can you explain that a little bit more? And also the word guarantee, because as an investor or someone who's interested in these products, people go for that word. Psychologically, we just say, all right, it's
Absolutely.
guaranteed. Let's go for it.
So I think any of these complex structured products, see, we are discussing this product because it's complicated. We are having difficulty comprehending this. Some of the viewers of the show are having difficulty comprehending this. Imagine the person in the tier 2, tier 3 city who doesn't quite understand the functioning of this product. What is the fund management charge? What is a premium allocation charge? Now, this individual is told guarantee. So whatever the market gives, the highest is guaranteed, or stuff like that. The guarantee word can be misused in many ways. One can even say the market over the last 10 years gave 17%, so 17% is guaranteed. Now, how do you protect the individual consumer in that situation from an unrecorded conversation which is happening, which can make such statements? There was very recently, I wouldn't name the organization, but there was a product that came out which guarantees 11% return over a long period of a particular product. The actual return when you calculate is about 3%. And,
wow.
and this is actually in the brochures, and it's a large organization, and now people will get misled at some point. If my father saw that, he would say, hey, this is better than an FX deposit. It's giving me 11% returns over a 15-year period. But it's neither guaranteed, it's not 11% return, it's actually 11% of the sum assured. So guarantee word per se is very risky.
And one needs to really watch out for that.
And I don't know how they can watch out. Like, I, with all my training, would be able to see that, but I don't think my father can see that. And he's an intelligent man, he's been in the army, but he can't see that. It's not possible for him to see that.
And that's where the mis-selling comes in.
That's exactly where the mis-selling comes in. And I think we just need to be kind of careful with some of these words, like guarantees, complex products. I think that's why the consumer is much better staying to simple products. Either stay with your FDs or stay with your ULIPs, which are long term. And once you're in it, stay with it. Don't change very often.
Now, can we get into the specifics of NAV guarantee products? Or, what are some of the schemes there, and what are some of the choices that people have?
Sure.
People who really want to go in for this.
Sure. So we have, I'll mention the 4 most searched products because people are coming and searching for these. So the 4 most searched products are, there's HDFC SL Crest, there is ICICI Prudential Pinnacle Super, there is Bajaj Allianz Max Advantage, and there is SBI Life's Smart Manager. So these are the 4 products that come to mind when one thinks about highest NAV guaranteed products. All of them work pretty much the same as each other. There are certain features and benefits. So the HDFC plan, for example, gives you a guarantee of 15 rupees as the NAV, whereas you invested at 10 rupee, gives you 15 rupees as the NAV guarantee. So that means whatever you invest, you will get at least 50% above that over a 10-year period. So don't misunderstand that it's not a 50% return, it's 50% over. It's a very small return, but it's guaranteed. So it's capital plus 50% over a 10-year period is guaranteed. The ICICI plan also guarantees the 15 rupees, but it also guarantees 110% of the return that you can, of the highest NAV. That's an important one because when you do the highest NAV calculation, the returns do come out to be a certain amount, but when you add that 10%, they can be higher. The Bajaj Allianz plan again works very similar to the ICICI plan, very similar cost management, etc. The SBI plan is slightly more effective because the SBI plan has a fixed fund management policy administration cost.
So Yashish, what we'll do is we have to take a short break, and when we come back, we'll talk about the SBI plan because you said there are certain advantages to that.
Sure.
Right. But if you have any queries, do write to us on ask.policybazaar.com or on Facebook at PolicyBazaar India, or you can tweet us on PolicyBazaar_in, and we'll see you after a short break. Keep watching.